Hello again, Nate Swaby here with Swaby Estates, and another Shop Talk episode in terms of economics. I think is a good place to start today. I wanted to get a little bit more elaboration on the economics of Canada right now in terms of real estate and where we stand in terms of macro and micro economics and how that plays into real estate. So ideally today, the reason for this topic is because we're kind of in a position now where we're going to be transitioning into I guess you say in terms of the business cycle, economic cycle, we're transitioning now from a recessionary or at the end of a recession, or we can call it the beginning of a recession, into a recovery phase. And the reason why we're running into these areas of the phase is because the next phase in the cycle, assuming that inflation is not on the rise, assuming there's nothing that's propping up inflation anymore, and we can see that the data is actually gradually reducing inflation, and we see this in Canada. Obviously, we have the United States down south. Their inflation is a little bit sticky still in certain areas in terms of inflation, but they're still receiving the same relative results, just it's taking a little bit longer. So in terms of both the Bank of Canada and the Federal Reserve's commentary is more aligned with consistently keeping the interest rate where it is to elongate that out a little bit more so that they can actually continue to reduce the inflation and see that progression. In Canada, we still are on that same topic. However, we are still seeing our inflation coming down a lot quicker relative to the United States of America. So the reason for that is obviously we have two different economics or economies. And because we have two very different economies, in particular, with regards to amortizations. So when we're talking about your mortgage, you might be buying a house, 25, 30-year amortization, but the mortgage itself has a fixed term of usually around 5 years is typically where you'd see on a higher end of fixed rate in terms of mortgages. And every 5 years that will typically renew, or 3 years, whatever you choose to select in terms of terms. But in the U.S., you can actually get into the bond section in which you can have a mortgage as long as 25 years. So a very big difference in dynamics in terms of lending, and in large cases, with regards to large cases of lending, you're talking about housing, which is very, very large, obviously, equity. So with that being said, because they do have that 25-year option to fix a rate, it definitely keeps them shielded from such a change like this in terms of a year or 2 or 3 years worth of interest rate hikes. They at least have that shield. Now, where they might not buy as much right now, because obviously by buying they cycle themselves into a new rate of interest rate for a mortgage. Obviously that doesn't benefit them. So most people in the US, if they do have a house already, they'll probably sit tight because it doesn't make sense for them to go out there and buy a brand new house with a brand new mortgage, and they don't have the ability to transfer mortgages like we do. However, on our side, we have short-term fixed rate mortgages, and of course, you're kind of not shielded. There's no way around it unless you predicted the market perfectly and had a crystal ball, and you could have maybe signed on a 5-year fixed rate when the rates were exactly the lowest, and then probably get through this, most of which would be already in the second or third year of that term. You have another 2 years left on that 5-year fixed. So either way, you're not fully resilient to it, and at some point you will have to renew your mortgage, and of course these new rates will affect you. So with Canada, because of this dynamic, it's made things very difficult for Canadians, especially this year in particular, where the majority of mortgages are becoming due in terms of renewals. So a lot of Canadians are only now starting to feel that pain from the interest rate hikes and how that kind of trickles through their cost of living. So with that being said, if we have a large majority of people coming into renewals, you're going to start to see a lot more people feeling the interest rate pinch, and of course the cost of living becoming more difficult for them as well. And of course with economics, a lot of things can happen from there. Of course, we still have job layoff section. We're starting to see that, especially in the larger companies, tech companies, and they're shimming down. A lot of companies tend to shim down their labor force, obviously, to conserve capital and become more lean in terms of the particular departments they might be focusing on in terms of leaning out particular staff, and this happens to affect everybody at the same time, right? So naturally, if interest rates are high and cost of living is high, and then all of a sudden we have job layoffs, which tend to lead into what some of what the Fed and the Bank of Canada tends to look for, not only just inflation coming down, but the unemployment rate rising rising. And obviously, if unemployment rate starts to rise and inflation is coming down, this becomes one of those metrics that they're looking at, and it also signals them to start reducing rates. So we are starting to see layoffs, and we are starting to see, in particular Canada, inflation rates coming down. I know that the Bank of Canada wants to reach a rate of 2%, which is also the same mandate as the United States. Obviously, ours is coming down a lot quicker, naturally, because our economy predominantly derives on real estate, and since we have the cycle of the renewals, that's going to hurt a lot more people a lot more quicker and affect the country and economics a lot quicker. So now that we're starting to see these things happening, there's a lot of other factors that actually kind of add into the damage there of these high interest rates and the cost of living being high. Of course, we have, obviously, Canada's had a high immigration rate, especially with non-permanent residents. So we've had a lot of students coming in and professions and younger generation coming into our country, but at incredible rates over the past few years. Now, obviously, there's been a change in policy to reduce that. So naturally, if you're going to take a number of people coming into the country, especially students, these are all people that are renting. They're in the rental markets, and naturally the rental market's been very good in Canada for quite a while, and a lot of this has to do with immigration as well. So as people are flooding in and looking for places to live, there's a demand obviously for these properties, and naturally we're building out all these properties and condos and stuff like that. It just can't happen fast enough. But now with a reduction in immigration, which happens almost instantaneously, which is where I find that to be the issue, because instantaneously cutting will affect on a greater scale, on an macroeconomic level, will affect very quickly the economy, right? So as we see in the markets today, especially in the leasing market, we're seeing that the rental market starting to pick up in terms of supply. So there's a lot of supply on the market because it's a lot harder to find a person to rent, or a good person for that matter, to rent to in this market when you're dropping down the amount of people coming in very quickly. Now, not to say that we should not do that, but there's gradual ways, of course, of doing that to not impact things so fast. But of course, policies will change and people make the decisions, and we just obviously have to deal with what comes with it. Okay, so now there's other things that also affect the economy in terms of our economy. Now, obviously, again, keeping in mind the U.S. is very different in terms of how their economy runs to ours relative to real estate. But when it comes to other economic things that do affect this, is we now have the government of Canada that's decided that they want to increase the capital gains tax. Now, their idea is to, first of all, they want to still all this capital coming in, and they want investment, and they want things to be built, and all these investments coming into Canada to do all these great things, but then they also now want to charge more for this. So all these large investors and people with a lot of capital coming in, they want to encourage them in, but then at the same time, they also want to increase capital gains to 2/3 as opposed to the 1/2 that we originally had. So with this being said, it seems kind of counterintuitive to me, but nonetheless, this is a policy change again that they're putting into place, which is going to in my opinion, hurt a lot of the capital investment coming into the country. Now, obviously, they state that it will only affect the very few 1% of people that are on the top. However, I tend to disagree, as the 1% that they're reflecting to don't necessarily fall in line with the people that perhaps maybe own a house. Now, of course, if it's your principal residence, it is got the capital gain exemption. Being a principal residence, you obviously can sell your property and not pay any taxes on it. But if you do have an investment property, perhaps, whether that be detached, condo, whatever, and you have tenants in there, maybe you've had it for a long time, or perhaps, this is, your children take over your house, and now they're getting the disposition of the property into their name. These simple things can easily trigger capital gains. And of course, if you're making over $250,000 in terms of that transaction, well, guess what? Now you're paying 2/3 on that. So it can't possibly only affect the 1% of the mega wealthy, as they say. It actually will affect average individual as well. But keeping in mind how this affects you in economics, of course, if you are to now have to pay capital gains at 2/3, a lot of people may actually hold back from actually selling their assets in order to obviously save themselves from a capital gains, or better yet, not even invest in large quantities. Why not just go and invest in the United States of America, where you can make more in terms of capital gains, right? So, pay less in terms of capital gains. But the bottom line is there's these policy changes that add on to all the issues that we have, and whether you consider them good or bad. Now, naturally, most people would say, well, no, it's a great thing because the rich will get what. Well, you happen to fall in line with that if you have an investment in terms of assets, and in terms of a house, of course, these are larger assets. Your likelihood of making a $250,000 is not unlikely. So keeping that in mind, and then some other policy changes that obviously could affect the macroeconomics as well is just simply them trying to speed up. They want to actually have accelerator funds for developing rental properties, for developing more properties. They also want to try to open up in terms of they actually kind of going over top of the provinces in terms of trying to accelerate triplexes, fourplexes, and so forth, and density zones, especially by like I know in BC they have density zones, so anything around transit lines they're able to build high rises and have heavy density. So these policy changes are also things that would typically help our scenario in terms of building and developing. Now the problem with that is if the interest rates are so high that most people can't afford or buy, then the idea is how are you going to build these things? Because developers would need to have these things sold out prior to getting any lending on buildings or developments. Also very counterintuitive. Now, granted, in the long run, I'm sure these policies will do their pay their course. Like, in the long run, naturally, the builders will be able to get off the ground and start building these things as interest rates decline, and there are investors again in the market to look, because as of right now, it's a little bit harder for an investor to make sense of the math on buying an investment property, when most times with the interest rate where they are, you won't even be able to cover your rental payments for your mortgage. So again, coming back to the majority of the people who might be buying a condo, especially at the very inception of it being built, is likely to be investors. You got a capital gains tax giving them a reason why they probably might not want to, because they're going to make a lot less money relative to the interest rates that they're paying for the cost servicing of this property as well. Not to mention the risk they're taking. Now, granted, the future is bright. Things do get better and rates will come down. But until then, you're not really enticing the investor to buy. They're almost criminalizing the investor at this point. But nonetheless, if a developer is not going to be able to sell out their units, how are they going to build this building? Or more importantly, is if there's a lot of bureaucracy around trying to build these things, that's another thing that would prevent a builder from building out these properties. So we have a government that wants to have all this investment and capital investment, but then they put counterintuitive measures and policies in place to prevent it from happening simultaneously when we're in a position in which interest rates are high and most people cannot qualify for a mortgage anyways. So it's interesting when you start to think about the economics of it all, and when we're lining up where we're at right now in terms of all these policy changes, because they've happened so drastically and they pretty much take effect pretty quickly. It will affect the economy, of course, because these things are going to take into effect right away while the interest rates are high. And what we're seeing again in the market is a lot of supply being bound up. Now, granted, if you're going out looking for a detached home, that's fantastic. There's nothing wrong with that, because you can go out and get a deal right now, assuming you can qualify for a mortgage. Maybe you get that opportunity you didn't have a couple years ago when the market was really going out of proportion in terms of multiple offers and the amount of people rushing to homes. But if you're going in as an investor right now, again, you'd be taking a bit of a sacrifice at the start with the interest rates, knowing that the interest rates will be reducing over time. So the benefit is you'll get something cheap today, and then as rates come down, the asset will grow. There's that benefit. But in the meantime, you still have to keep in mind that you're going to be paying perhaps out of pocket for the next little bit until rates start to decline. But as a person coming in to privately own this property and live in it, yes, the mortgage will be a little higher. However, you can get a better cost for the property, of course. And then as rates come down, you'll benefit from the equity that it'll build. So in the meantime, while supplies are starting to bog up, it makes it a lot harder for an investor if you have a property and a tenant leaves or you need to find a tenant, that's going to be a lot harder to find. Why? Because of immigration reducing drastically, the cost of living still being high. So you may be put in a position in which you have to reduce your rents in order to get somebody in while you're fighting with everybody else trying to find a tenant. The condo market, very, very abundant. A lot of condos in the market right now. Naturally, it's the out of all the asset classes going from detached homes to townhomes to condo townhomes to condo apartments. The condo apartments are usually last in terms of asset class, and naturally there's an abundance or a density level of them. So when everybody's trying to sell at the same time, it makes it very difficult to find buyers or renters for this case. The detached market seems to be relatively decent in terms of people still out there buying homes because they're for families, and a lot of families still need homes. Now again, assuming you qualify, so there's still a lot of people that are on the sideline that cannot qualify, and things will change over time. But in the meantime, as our economics are the way they are, and we have high interest rates, we have all these policy changes, right now it is not looking too good for Canada in terms of the short term, because even if they start to drop rates, which we assume there may be a possibility in June, since Canada is already lower on inflation relative to the US, even with the rate drops, we won't see a 2% rate drop. It'll be more like a 25 basis or 50 basis point drop, or maybe 25 basis for the next 2-3 quarters. Now that gets you like maybe a 1% drop within this year, and maybe another 1% drop for next year. Now, will that make a big difference? It will over time, but in the short term, it may not make a big difference because these drops are not substantial enough to make a huge difference for the average buyer. So to give you a little context of that, add in the fact that the United States is doing fairly well, and their inflation rate is still a little bit sticky, so they will maintain that rate a little longer. If we start to drop rates as a country, any country can drop rates, but knowing that the US is the one that tends to control, obviously they have their leading currency. If they don't drop the rates and Canada drops rates, we also get a decrease in our Canadian value in terms of the dollar. So then that will also affect our trade, right? In terms of buying from the United States or even traveling to the United States, the cost of that goes up. Obviously, probably less products being bought, or inflationary in a sense, because you'd have to pay a greater dollar, Canadian dollar that is, for US products. And then of course on the opposite side, our GDP would increase in terms of trade and stuff, because obviously the Canadian dollar is weaker and the US has a stronger dollar. They'll be able to buy more supplies, assuming they want them, of course, but that'll tend to pick up. But it's the cost that we'll pay in association with buying in to products in the United States and bringing them over, or of course just simply traveling. So just a lot of things to think about, a lot of things, how they work together, and economically we have a lot coming ahead that has changed our country, and obviously we have an election next year as well, which I'm sure a lot of people are pretty excited for that. But in the meantime, this is our economy. Now things will get better, obviously, but it's just going to take time. And with policy changes happening, it does put a little pressure, additional pressure on our country. So there is a chance that we could be in a little short-term spiral here with regards to the housing market. But again, for those of you that are investors, maybe it's a good time to buy something as we get into these markets, because it's going to be a little harder for the seller. Definitely be a buyer's market, or in this case, a tenant's market, looking for a place to rent, because there's a lot of options out there now. But things will get better. They always do. This is part of the cycle, and this is how our economies change. And of course, world powers change and stuff. Maybe even currencies one day change, right? Right now, the US dollar is the leading currency, but that could change one day as well. So just things, context, and understanding of what's going on in our economics today. And I hope you found this enlightening, or at least helps break down some of what's going on today in the markets. And of course, we'll continue to do these videos to help with regards to understanding, whether it be investments, whether it be policies, whether it be economics, macro, micro, but ideally it always comes back to real estate and how that correlates. Again, thanks again, and have yourself a great day. Nate Swaby signing off.